All right, trading higher volatility markets. Know the seasonality so you're not rug pulled. But the number one thing is complacency. I want to talk about the top four things that are the enemy if you're going to be in trading and you're not aware. Number one, taking things for granted on market conditions. If you've been looking at the market in 2024 glasses and you still have that outlook, and then you were in last week's market and you were a perma bull from Monday to Thursday, it looked like pretty much feeling bored with how the market was in a tight range. Number two, sticking with what you know. What you know has been the most recent past history. Buy the dip, dips always get bought, and the market always goes up. And number three is staying in your comfort zone. And number four, which is possibly going to be obviously number one in hindsight, not taking risks seriously. Any kind of market risk. We're talking about the stock market, especially in 2025. This is a different market. That's all I can say. And you've got to take the risk a lot more seriously than the prior 4 years. So a lot of people haven't got the message yet, and they're just looking at where we were at on Fridays, thinking it's a one-off event. But those are the four signs of complacency, and I wanted to get that out there. Let's get to the charts. So let's look at the complacency trap on a chart and see how the snare was set. Okay, I'm going to start with the Renko on the left with the Keltner channels, upper blue, middle red, lower blue. You can see how we closed on Friday, but I want to focus on this part of the chart right here. So it's best illustrated on the 4-hour chart. So each candle is 4 hours, and what we have here is last Thursday and Friday. Notice high resistance, overlapping candles, back and forth, all the way into the new week, which was last week, and just continuous. And then we have a break in the 20th, and then more consolidation. It looks like it's nothing more than a blip. This one break here happened. And then Friday consolidated. We're still in the range. All of Globex, all of London, all of Asia, and then the RTH AM session opens, kaboom. All right. So that was the complacency trap that everybody had gotten in the boat. There was news wires that said for the past few days, a lot of new money had flowed into equity funds at a torrid pace. So the boat was one-sided, and those in the know, the people that want to get people most trapped most of the time, they just basically kept prices elevated all week until the very last part of the week, which was the New York session. On the left, the Renko showing the consolidation. Note the red line. We had that peak here on the 20th. We come down, but we recover. And like most people, maybe people made money because they saw this as basically the lows were in, we had relative equal lows, and then we go back above the red line. But look what happens. Again, this was the RTH session on Friday, and we just go all the way to the lower Keltner. So that's the close, basically. And if you made money last week, it was because, number one, you didn't trade Friday and you were satisfied with Monday through Thursday and you stayed in cash, or you made a little money. You didn't catch the whole move down, but you were basically conscious and present to know the seasonality trumped everything. No pun intended. The main thing here is this tight range, high resistance, knowing it's high resistance, but we've got a 2 to 3 week overhang of seasonality, and we are only 1 week into it right now. So there's at least 2 more weeks to go, in my opinion. And again, that's not my research. Look at my previous video of the previous week. I give you where I get it, and I pay for that research, and it helps me create my bias. So these are the tell signs. Renko on the left, 4 hour. Let's go higher time frame and get a better look and a perspective view. Okay, we have the monthly on the left, weekly on the right. So on the monthly, what's jumping out right here should be real obvious. The candle bodies are the focus, not the candle wicks. Got lots of wicks here, but I'm more interested in the bodies. And the bodies, December, January, February, look how the bodies are just totally getting compressed like a coiled spring. This is high resistance and this is range constrained. It's being strangled. What does that mean? That means, since this is a very much of a higher time frame, at some point we are going to have a major breakout this year. And it's not necessarily going to be up. It could be a lot of downside, and you've got to manage that risk. So I'm just saying that's my opinion, my hypothesis, my narrative, and I'm taking it from the monthly. On the right, we just simply have a weekly candle that basically retraced the prior week. So the week of the 10th versus the week of the 18th, you can see here the body basically hasn't done a huge amount of damage yet because of this black line at 603. That's middle Bollinger Band. So that's one way to look at it right now. So that's why this week is so important, and how we end the month for February, how we start March. And we've got a lot of options expirations. We've got futures rolling over in a couple of weeks from March to June. I'm already trading June. I want to make sure that's noted here on the record, on video, and documented. I am trading June. All right, let's go to the next chart and let's look at points of interest. Let's look at the dollar, the VIX, and the Treasury. So these big yellow rectangles go back to December 18th. That's still a big, important fair value gap day. And notice the VIX got all the way to the middle, the 50% fib level or consequent encroachment, and it closed above. So the volatility may not be done, at least for the very short term. On Monday, we'll see if there's continuation. However, on the dollar, we've definitely closed below that December 18th, and the 10-year on the right is below it also. So what I'll be looking for is signs that next week we want to see the 10-year Treasury yield continue to hold lower. Same with the dollar. The VIX, this could wear off by the end of the week. But again, it could be another rug pull setup where they get everybody complacent again. And then middle of the first week of March, maybe the end of the first week of March, it could go and have another rug pull. So these are points of interest. I want to be, as an equity index trader, I need to be aware of these three canaries in the coal mine. Next chart. 1 hour chart. Okay. So this is really going to be the chart I use for Monday, 1 hour, 15-minute, and then down to 5 and 1. But I start with the 1 hour because I've already looked at the higher time frames. Let's go back to the week. So this was Valentine's Day close right here. And what you note here, after that, we had a new week open gap with this area here. So 6190 by 6193.75. That purple long rectangle was very narrow. So that was the first hint. And the reason I say that is the contrast below it was a daily fair value gap. So this is a weekly new week open gap from a week ago. And then prior to that, on the before Valentine's Day, we had this giant wide daily fair value gap that we never really, with the candle body, retraced all the way down. Now, Thursday, we did go down into consequent encroachment with the body of a candle, and we closed below it. We had a doji, and then we had a green candle, and then we escaped. So that was the fake out right there. People thought, "Okay, that's the dip, we'll buy it." And then what we did for hours, literally hours, Asia, London, all these bull traders got hosed completely, and then pre-New York, here's the dump. So I've got my first present right here, this area, and then we just totally blew out the daily fair value gap. And what's below it here is new week open gaps from January. So the light purple, dark purple, and then this yellow. This is all stuff below us that needs to be resolved one way or the other. So let's go to the yellow. That is election daily fair value gap when we knew everything had changed in our world in the United States on the 6th. So this has never been resolved really at all. And this is down where we break 6,000. And the low of this fair value gap is 59.25. I've got some February monthly lows here. We had 59.91. We've got a discount wick of the monthly. This is the monthly February 50%. I've got the new week. So there's a lot of overlap. That's what I'm trying to say here. There's so many lines. It could be confusing for some of you, but for me, it makes sense. And I want to keep these charts, and I have to redo them every 90 days because these are futures and the contract rules. So this is all for the June. So I'm going to take off this red line here. That's the low of the day for Thursday. So that's it. This is basically the complacency trade from last week. They really did a great job of busting through, but they've not gone here and retested the monthly lows. So this is suspect here that we could go and revisit this if we don't spike back up. These are, again, 1-hour blocks here, and we could see there's some fair value gaps. Maybe we recover some of them, maybe we don't. But what we do know is there's going to be a new week open gap, and no one knows. We know where we closed on the RTH, but we don't know where we're going to open on Monday Globex. I'll be charting that, and stay tuned for another video in the new week. If you've been paying attention, you've been watching the videos, I'm not going long. I don't plan on going long anytime soon, at least for the next 2-3 weeks. And I'm either going to be in cash, which I presently am. I don't want to have risk on at all during the weekend. And if I put risk on during the week, I'm not going to sell in the hole here. So that's my parting shots on where the market is. You've got the levels, points of interest, and I'm paying attention to all of it. Aloha, take care, be safe out there, and don't fall for complacency traps, okay? Bye.